Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show. This is Jason Hartman, and this is episode number 193. Thanks for joining me today. So today we're going to talk about real estate scams for a moment, and then we'll talk about nationwide legal services. And before we get into that, I just wanted to talk about a couple of items that I found interesting recently. Number one is one of the newsletters to which I subscribe talked about commodity prices, and they quote saying that over the last 5 months, the Commodity Research Bureau Index has already climbed by 23%. And so this means that 19 different commodities in the index, ranging from food to energy, have shot up. When you take a closer look at this, you see that sugar prices have more than doubled since June. Think about the significance of that, everybody. 5 months, prices have more than doubled for sugar. And listen to this. Cotton prices are up 84% since June. That's in 5 short months. Wheat is up 50% in that time. Coffee, how many coffee drinkers out there, is up 47% in 5 months. And they say even when preparing for Thanksgiving, you'll probably notice that the usual turkey costs 28% more than it did this time last year. But that's not all bad news. Even with rising food prices and a sinking dollar, a handful of investors will make a windfall profit over the next few years. And you know how they're going to do that, folks? They're going to do that by following our plan. And what are the 2 very best things you can do when faced with inflation? Well, Ben Bernanke, look at what he's recently said. In fact, you know what? I'm going to play you a little video here, the audio track from a video that's been floating around the internet recently about quantitative easing. And you may have heard this. It's been all over Facebook, and you may have had it emailed to you. Maybe not, but in my circles, I've seen it. I'm going to play you the audio track from that. It's about 5 minutes long. And it's just really interesting because Bernanke is totally opposed to deflation. And that's actually good news for us as investors following our plan, isn't it? Because you know that come hell or high water, he is going to create inflation. And he's already creating inflation in the things that we need, obviously. Not so much yet in the things that we want. So we're still in this era of massive, massive monetary inflation and asset deflation. So I'll play that in just a moment here. But the 2 best things, what are they? Own and control commodities, and own and control, in the same sort of sense, long-term fixed-rate investment-grade debt. You've heard my mantra for so long now on this show talking about those 2 things. I call that the ultimate inflation shield and the ultimate investing equation. Commodities tied to long-term fixed-rate investment-grade debt, the ultimate way to go. Let me play for you the audio track from this little, I think that's called Animoto, those little funny cartoonish videos, and it's a computer-generated voice. So instead of calling him Ben Bernanke, pronouncing his name properly, they say the Ben Bernanke, and it's almost funny just listening to it. It's just kind of funny the way the voices are. So I'll play that for you. Then I want to come back and talk to you just a quick analysis on a couple of different properties that we're looking at. I've been buying properties quite a bit lately, just closed on one more property in Indianapolis. Really excited about these properties and just a fantastic time to be stocking up on these packaged commodities, these ingredients that build these great little houses and little apartment buildings, because you know what? I'm buying them at 50% or sometimes even 33% of the actual replacement cost. Just got my insurance policy on one of these properties, and I've talked about that on the show, and that insurance policy won't even cover the cost of replacement. So if the house burns to the ground, the insurance policy will not cover it unless I get coverage for more than the actual purchase price of the property. So you've got a built-in good deal there, don't you? It's pretty much automatic. Okay, listen to this funny little video. I think you'll really appreciate the computer-generated voices. They make it really, really funny by the way they mispronounce things. And then I'll be back to talk about these properties, real estate scams, and nationwide legal services. And here we go with a little video.
Did you hear about the Fed?
No, what about the Fed?
They announced another round of the quantitative easing.
What does that mean?
It means they are going to make large asset purchases via PAMO.
What does that mean?
It means they are going to expand their balance sheet and buy treasuries.
What does that mean?
It means they are going to print a ton of money.
So why do they call it the quantitative easing? Why don't they just call it the printing money?
Because the printing money is the last refuge of failed economic empires and banana republics, and the Fed doesn't want to admit this is their only idea.
So why do they want to print the money?
Because they say we have the deflation, and the deflation is very bad.
What is the deflation?
The deflation is when prices of the things we buy go down.
Isn't that good? Doesn't it mean the people can buy more of the stuff?
Yes, but the Fed said this is bad, especially during the recession.
So they think that during the recession, when the people have less money to buy the stuff, it is bad that the prices go down?
Yes, the Fed would rather have the inflation.
So why does the Fed think we have the deflation?
Because the CPI said so.
But aren't the food prices higher than a year ago?
Yes.
Aren't the gas prices higher than a year ago?
Yes.
Aren't the healthcare costs higher than a year ago?
Yes.
Aren't tuition prices higher than a year ago?
Yes.
Aren't the taxes higher than a year ago?
Yes.
Aren't the subway fares higher than a year ago?
Yes.
Aren't the stock prices higher than a year ago?
Yes.
Aren't the bond prices higher than a year ago?
Yes.
So what is deflating right now?
The only thing deflating that I can see is the Fed's credibility.
Did they have a lot of credibility to start with?
No.
Why not?
Because the Fed has been wrong about every major economic development in the past 20 years.
You mean they didn't see the internet stock bubble?
No. In fact, they helped fuel the internet stock bubble.
And they didn't see the housing bubble?
No, in fact, they helped cause the housing bubble.
And they didn't see the subprime crisis?
No, in fact, they told us subprime problems were contained right before the hit the fan and the Lehman went bankrupt.
So has the Fed ever been right about anything?
Let me see if I can think of anything. Nope, nothing.
Who runs the Fed?
The Fed is run by the Ben Bernanke.
Does the Ben Bernanke have a lot of business experience?
No, the Ben Bernanke has no business experience.
Does the Ben Bernanke have a lot of policy experience?
No, the Ben Bernanke has no policy experience.
Has the Ben Bernanke ever run in an election?
No, the Ben Bernanke has never run in an election.
So what qualifies him to run the Fed?
I don't know, maybe the fact that he has a nice beard.
But my plumber also has a nice beard, and I would not trust him to play God with the economy.
No, although when you call the plumber to fix something that is broken, they usually fix it, not break it more.
This is true. The plumber is clearly smarter than the Ben Bernanke.
Well, that is why he became a plumber, and not an economist.
How does the Fed execute the quantitative easing?
They print the money, and then they buy the treasury bonds.
Do they buy the treasury bonds from the Treasury Department?
No, they buy the treasury bonds from the Goldman Sachs.
You must be me.
No.
So let me get this straight. If I want to buy the treasury bonds with my money, I can buy them directly from the Treasury.
Yes.
And if you want to buy the treasury bonds with your money, you can buy them from the Treasury.
Right.
But if the Ben Bernanke wants to buy the treasury bonds using the American people's money, he does not buy them from the Treasury, he buys them from the Goldman Sachs?
Exactly.
And does the Goldman Sachs give him a good price?
Of course not, they are the Goldman Sachs, they make their living ripping off the American people.
But how is the Goldman Sachs able to do this?
The Fed announces what it is going to buy, and when it is going to buy, before it does the trade.
So the Goldman Sachs can front-run the Fed, and give them the worst possible price on the treasury bonds?
Yes, exactly.
And the Fed is okay with this blatant theft from the American people?
Of course, otherwise, the Fed would just buy the treasury bonds directly from the Treasury Department.
Who inside the Fed is responsible for the buying of the treasury bonds?
The buying of the treasury bonds is conducted by the New York branch of the Federal Reserve.
And who is in charge of the New York branch?
The head of the New York branch is the William Dudley.
And what did the William Dudley do before running the New York Fed?
Before running the New York Fed, the William Dudley was a partner at the Goldman Sachs.
So the guy in charge of the American people's money when dealing with the Goldman Sachs used to be a partner at the Goldman Sachs?
Yes.
And nobody has a problem with this?
Apparently not.
Is this an episode of The Twilight Zone?
I don't think so.
Are you sure?
Pretty sure.
So what you are telling me is that the Fed thinks prices are going down, when in fact they are going up?
Yeah.
And they think during the recession, with the high unemployment, it is better if the things people need to buy cost more money.
Correct. According to the Ben Bernanke, the inflation will create the jobs and improve the housing market.
Has this ever been tried before?
Yes, just last year the Fed tried the quantitative easing with $2 trillion.
Did that create the jobs?
No.
Did it help the housing market?
Not at all.
Did it help anybody at all?
Yes, it helped the Goldman Sachs.
How much of the money are they printing now?
$600 billion.
So even though the first $2 trillion did not create the jobs or improve the housing market, the Fed decided to do another $600 billion anyway?
Yes.
Who put the Ben Bernanke in charge?
The Ben Bernanke was first appointed by the President Bush, then he was reappointed by the President Obama.
But wasn't the President Obama supposed to bring the change?
Yes.
How is putting in charge the same fool, who has been wrong about everything, the change?
Well, under the President Bush, the Ben Bernanke only blew up the American economy. Under the President Obama, he is working on blowing up the entire global economy.
That does not sound like the change we can believe in.
Definitely not.
Who else supports the Ben Bernanke?
Most economists around the world think the quantitative easing is very dangerous.
Does anyone think it is a good idea?
Yes, the people at the Goldman Sachs.
Is this some kind of nightmare?
No, it is very real.
I want to bang my head against the wall.
You should not do that.
Why not?
Because the healthcare is too expensive.
But didn't the President Obama fix that?
No. But that is the subject of a whole other video. Goodbye.
So I hope you enjoyed that funny little video, the audio track from that video. It's really funny. It was actually, I was on one of the local radio stations here last night, KFI AM 640, with Tim Conway Jr., just commenting because he played the audio track from that video, the one you just heard, on the air last night. And it's just really, really telling what is going on out there. But again, following my strategy, you can benefit from it. And you got to love how they talk about printing money, or quantitative easing as they call it. What a misnomer. Is really the last refuge of banana republics. And it is, but the U.S. isn't faced with the same problems that banana republics have been faced with money printing. Why? Well, because we've got the biggest, most powerful military in the world. We have the only reserve currency on the planet. And so we have a different situation. A lot of people like to liken it to Zimbabwe. I've made the references myself on prior episodes, but the circumstances are very different for the United States. There's very little that you can compare to a banana republic like Zimbabwe. But irresponsible money printing, yeah, we're doing that. We're doing that, definitely. Okay, let me talk about a couple properties here that I want to just do a quick overview with you. And these are on our website at jasonhartman.com, so you can actually look at what I'm talking about here. First, I'd like to talk about one in Phoenix. And we've been doing a lot of business in Phoenix lately. This week, several of our clients have purchased in the Phoenix area. We've got some great deals in there now, and I'm really glad to say that we've reopened this market. We timed it perfectly. I mean, you couldn't have timed it better. And I know I'll stop patting myself on the back here, but we moved out of Phoenix when the bubble was getting too big. We moved back into Phoenix just recently, long after the bubble had burst and everything came to half price again. So check out one of these deals. This is a duplex. It's actually a duplex property, 2 units, 2-bedroom, 1-bath units. It's been remodeled, and total square footage it's small. It's a small duplex, 1,650 feet. The price is $75,000. Now, did you think that you would buy not 1, but 2 units for $75,000? Pretty good deal. Total cash needed to buy this property, just over $22,000. The price per square foot is $45. Projected rent is almost $1,100 here, and your positive cash flow is projected every month at $386. So check this out. You invest just over $22,000, and you get $4,600 per year on that investment. And this is an 11.2% cap rate It's got an awesome debt coverage ratio of 2.23. That's phenomenal, folks. I mean, that's a phenomenal debt coverage ratio. Again, you can see all these numbers on jasonhartman.com. Just click on available properties. And the projected return on investment here, cash on cash, 21% annually. That's about 21 times better than the bank, by the way. And the total ROI projected at 37% annually. So, I mean, what a phenomenal deal. Let's move to Denver, Colorado for a moment. A little bit more of an expensive market, but we just got a very nice email from a client yesterday, actually, who was raving about his investment there. And Denver, Colorado, $120,000 for a property that was built in 1999, 3-bedroom, 2.5 bath, and this is a pretty darn good deal. It's already leased. This property is already leased for $1,150 per month. It'll take you $27,360 to buy this approximately, and here's what you're looking at: a positive cash flow of $309 per month, or $3,700 annually. So your projected return on investment here is 14% cash on cash, and total overall return on investment projected at 32% annually. Wow! Why aren't you buying up properties like crazy now? If you are not buying now in these good markets, again, I'm making the disclaimer, I'm not talking about overvalued markets like California that still are going to lose another 10 to 20%. I'm talking about markets that make sense where you're buying far below cost of replacement. Check this one out. This is back in the Phoenix metropolitan area. This one is 1,832 square feet. It's built in 2002. I'm looking at the picture. It's a beautiful property, single-family home, 2-car garage, corner lot, $78,900. You'll need about $20,000 to buy this property. You'll only be paying $43 per square foot. It would cost you double that to build it today. Projected rent $950 per month. Cash flow projected at $242 per month. So think about it. Here's your number. You put down $19,800 total with closing costs, and you get $2,900 per year back on your money for a cash-on-cash return of 15% annually and a total overall return projected at 35% annually. And by the way, the lot size on this, it's large, 6,837 square feet. Beautiful 2-story home, really nice-looking property. So again, take advantage of the opportunities out there. I am very bullish now in these markets because they just make a lot of sense. Now, we all know Wall Street is riddled with scams, but the real estate industry has its share of scams too, and that's why we say be a direct investor. But even as a direct investor, you can still fall prey to a scam. So again, that's why you want to have a prudent investment counselor that you trust, someone who goes over all the details, who vets the properties, who vets the opportunities, who vets the broker that you're dealing with, and so forth. And that's what we do here at my real estate company, Platinum Properties Investor Network Incorporated. So here, we're going to just examine one scam that we recently came across that was one of those sort of too good to be true deals. And our local market specialist, I emailed the information to her right away in Indianapolis because that's where the property was that this guy was promoting. And boy, it sure reeked of a bit of a scam. So we're going to go over that. Then we're going to talk about some legal services, and we'll be back with exposing a scam here in just less than 60 seconds.
Jason provides an extremely unique service, Deal Evaluator. Are you interested in a property outside of our network? Need a second opinion? No problem. Let our experts evaluate the deal. Find out more about it at jasonhartman.com. The price is only $50.
It's my pleasure to welcome Angela to the show. Angela, you have heard on the show before. She is our local market specialist for Indianapolis, Indiana, and we've been doing a lot of business with her for several years now. And I recently emailed her about a property in her market that looked interesting, and I think I'm on just about every email list on earth, or at least as it relates to real estate investments and business opportunities and things that interest me like that. And it looked like it was really too good to be true. And it's just great to have local market specialists specialists in all these different markets around the country. And when I get something that looks interesting, I just shoot them an email and they can respond and they know what's going on. And Angela knew about this right away. So I wanted to have her on the show to just discuss a bit of a marketing ploy, a bit of a scam, if you will, that's going on. And Angela, it's great to have you on the show. How are you?
I'm doing well. Thank you for having me.
Good, good. Well, this isn't your first time on the show. How are things in Indy?
Well, the market's kind of picking up. There's a lot of homes available. Sometimes it's a little bit more competition now as more investors are entering our market. So if you see something that you really like, I say move quicker than later.
Yeah, and I just bought a property from you, and I'm excited about that one. Looks like about a 20% cash-on-cash return annually. So there are some very exciting opportunities out there. So just refresh my memory a little bit about what I emailed to you, if you would, and let's kind of dive into this and talk about some of these scams that are going on where investors are just, things are being promoted that are just clearly too good to be true many times. And you recognize this one right away. So I wanted to have you on the show to talk about it. What's it all about?
Well, you forwarded me an email where you got from a gentleman offering a home for sale at 45% of market value for $34,900. In his email, he had told you that he purchased it, or it sold in 2009 for $76,000, and you bought it from the bank and did a ton of fix-up work on it. When you see something like that, it is too good to be true. So that's why they're sending you that. He goes on to say it was a completely passive investment. It's a great deal. Later on in his email, he said that, you needed to wire him a $1,000 non-refundable deposit into his account and that he could close it at his title company within 2 to 3 weeks, which are all red flags.
Right. Yeah, they are red flags. So first of all, the thing that you instantly did when I sent you that email, because I was amazed at how quickly you just replied and you checked it all out real quickly, and you found out that the sales price information of, I think, $76,000, you said, that wasn't actually true, was it?
No. He bought it in October of 2009 for $12,000.
Wow. So October 2009, he paid $12,000 for this property and claimed that he paid $76,000?
Yes, that's exactly right.
And what's he selling it for? $34,900? So he wants to triple his money on this deal.
Yes.
And say that he's selling it for half of what he paid.
Yeah, and it's a great deal to you, the investor.
Wow. That is really not a good deal at all, is it? So, Angela, how can a guy like this it's just a blatant lie? Is there anything else to it? What's his story going to be if someone hauls him into court and says, hey, this isn't true?
It is a blatant lie, but what he's banking on is the fact that there's an investor in California or someone else that isn't going to check the facts, that's going to think, oh my gosh, this is too good of a deal to pass up. They're not going to have someone in that market, such as me or any of your other local market specialists, looking out for them checking. You could have offered it to your investors, but the first thing you did was make sure that it was an actual deal. And too many people are going to be excited and they're not going to check the facts. And when they don't, they're going to end up purchasing this home and being stuck with it. In his email, he says that you have to pay cash for it, which is another red flag. What he's saying is he doesn't want it to go through a bank because it's not going to appraise. And once he has your cash, he's going to run with it. So
interesting. I just pulled up the email as I was talking to you. I'm sorry I didn't have it ready here for the beginning of this chat on this. And the email subject line says 55% below market value, completely turnkey passive investment. And here's what he says. He says, hi, Jason. I've got a little house for sale in Indianapolis, Indiana. And by the way, I looked that up on Google Maps right away. And he's got a picture of the house. Price is $34,900. He says this property sold for $76,948 on October 29th, 2009. We bought it from the bank, did a ton of fix-up work, and put a stable Section 8 tenant in there. So it's basically, by being really specific like that, things appear to be more true. Now, I have to say that when I got that information from you, and this was back in July, so this is a couple of months ago, I emailed him. In fact, I think I emailed him 2 or 3 times on this, and he never responded to my email asking questions about it, because I was asking for details, and I think he probably thought, well, I've figured it out. So he says this has $350 a month positive cash flow. What else on this, Angela? Any other thoughts on it?
After we did this, I actually drove by the property because I wanted to see if the photos actually reflected what the property looked like today. Number one, it didn't look as good as the photo looked anymore. It hadn't been maintained in a while. And it was also for rent. In his sheet here, he states that it's actually currently rented, which it wasn't. There was a for rent sign in the yard. And then he also went on to say that he had his own property management company that does Section 8s and da-da-da-da-da. Buyer beware. You need to check these facts. It's really and really important that you have someone looking out for your best interest, or you're going to end up being stuck with a property like this that was too good to be true.
That's interesting because I didn't even catch that. I'm looking at the picture right now in his email, and it does have a for rent sign in it, and then he says it's rented. But driving by it, it's not going to have a for rent sign if the Section 8 tenant is in there like he says they are, so... Thank you for listening to the Creating Wealth Show. This is Jason Hartman, your host, and we appreciate you following the show. We have many, many episodes, hundreds of episodes, and some of the older episodes have been archived and placed in our members section, and that applies to this one. So we include a sample that's about 25 minutes long, and then for the rest of the show, you can go to our members section at jasonhartman.com. Many of the other shows are still in their full-length, complete version. However, some of the shows, like this one, are in our members section where you can hear the show in its entirety. And again, you just need to go to jasonhartman.com and you can get the full show there in the members section, plus a whole bunch of other great members benefits and resources, whether it be documents, forms, contracts, articles, other video and audio content. Just a great resource. So be sure to join as a member at jasonhartman.com. And thanks again for listening to the Creating Wealth Show.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.